Good morning, traders, and happy July, 1st of July. It is 8:06 a.m. Chicago time on the 1st of July, 2015. Sorry about the delay. It took a while for the broadcast system to come up. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. As usual, we'll run through the overnight news. Quite a bit going on overnight. The markets in Hong Kong and Canada are closed today for various holidays. It's Canada Day today. Happy Canada Day to our Canadian listeners. European equity markets are higher after word that the Greek Prime Minister Tsipras is prepared to accept most of the creditors' conditions on a handful of changes. This news came out at about 3:55 a.m. Central Time, and we've seen pretty large movement on the European equities and fixed income assets. Asian markets closed higher. Gold and oil are lower. The U.S. dollar is higher versus the pound, yen, and euro. A new bailout program for Greece is possible before the July 20th payment deadline. Remember yesterday, Greece missed or defaulted on the Tuesday deadline to the IMF. There's a deadline on July 20th to the ECB. It's prepared to accept all bailout conditions from its creditors. Referendum will proceed as planned on Sunday. Sunday evening is going to be very interesting, as these last couple of sessions have been. Negotiations with creditors will continue after the referendum. This morning in the U.S., June challenger job cuts came in at 44.8 thousand versus 41,000. Year on year, 42.7% versus negative 22.5% prior. June ADP employment change came in at 237,000 versus 218,000. This number is often a precursor, or looked at as a precursor for non-farm payrolls, which I'd like to remind you that tomorrow we have non-farm payrolls instead of Friday, and Friday is a holiday. It's a half-day trade on the electronic only. Looking at what we have left for today, excuse me. At 8:45 Central, we have U.S. manufacturing PMI final looking for 53.4. At 9 Central, a half hour after the open, we're looking for U.S. construction spending month on month. The number is 0.4%. At the same time, we have ISM manufacturing looking for 53.1. U.S. crude oil inventories at 9:30 Central. DOE U.S. crude oil inventories expected at negative 2.5 million. Distillate inventories at 1.15 positive. And gasoline inventories at 1 million positive. As far as speakers, nothing on deck for today, but do expect news to continue to flow coming out of this Greek thing. Let's switch gears here to the desktop and look at our markets and what they've done. Yesterday, for those who attended the Trader Bite, the primary hypothesis was for the market to likely rest inside of the prior day's range, given that it was a very, very wide-ranging trend day, second standard deviation and range. But I discussed at length the fact that we have this weak low that was put in the day before. Oh, that's not a very good color. The day before, and this weak low is likely to be taken out during the session. So we have a lot of volume and a day's point of control moving down at the end of the session on Monday, and we had a very weak low. Let's erase that and zoom in. I'll show you that again. There's no taper here on this profile. We see that the most traded price was very bluntly cut off at the low on the close, as opposed to what we would expect to be a normal taper, which looks more like this. As prices go down, sellers become less interested and there's less and less business to be done. That's a properly auctioned low. And in an excess low, oftentimes just looks like a market that just does this and then it's got, a little protrusion underneath it, and then we see a long candlestick. That's an excess low or strong low. What happened yesterday was as expected. Hypo 1 played out perfectly. We're looking for the cutoff point that I'd mentioned was at 72, and which is where we are right now. But yesterday we were expecting chop throughout the day. We're expecting it to chop around with a downward skew, looking for the week low to be tested. The week low was tested by 2 ticks for a very strong rotation up, and the market being quite balanced most of the day. The market's just waiting for news. Lots of selling on the close. If you watched that happen, or if you have a pit squawk, you would have seen and heard just a pretty fast adjustment on the cash close. That is the quarter end and mid-year close, June 30th. A lot of shuffling of positions that led to this pretty strong delta move down, and a lot of frenzy on the close. A lot of volume went off on the close. Very interesting trade. As far as where we are in the big picture, we still have room to test this 1150, but we're not there yet. We're still stuck in this very wide balance zone that started from February 13th, and it looks like, to me, it looks like this is done on the downside for now, given the news that's in front of us. Yesterday, the Nasdaq had a neutral day. The S&P did not, and now the S&P is opening higher. I'm looking for support below, and I'm looking for this to walk itself back to the point of control, which is 93.75. That's the key target above us, 93.75. Now, bring us back to the most traded area since early February, since mid-February. So, in looking at today's primary hypothesis, let's extend this out. Looking at today's primary hypothesis, we're looking at the market opening higher. We're trading right here, right now. I'm looking for this to have responsive selling. The overnight inventory is long, so we're looking for some balancing in the overnight inventory. I'm looking for it to test into this HVN and the high yesterday afternoon. If it finds support, and that's a big if, then I'm looking for this to chop up and move towards 2082, and then eventually towards that 92 area above. That's the primary hypothesis. If this comes down and breaks in and then is unable to get out of yesterday's range, that I'm looking for it to move to the point of control as the primary target, and then it's likely to get choppy and walk itself up to the close of yesterday, which was 54.50, and for it to rest here, assuming there's no news. That's hypothesis number 2. Hypothesis number 1 is a push up. So that's what we're looking at for a plan. I want to quickly show you what's going on around what's going on the monthly basis. This is the first day of the month, so we have a completed monthly profile. Here are our monthly profiles. You can see the story as it unfolds. February, a long day, a long month, a long-ranging month, a very wide-ranging month, and we've been stuck in the upper section of February for quite a few months now, with volume pushing, consistently pushing the same value areas, and the market's just having a hard time moving out of these areas right now. So what we've done is we keep moving from balance to imbalance, balance to imbalance on a monthly basis. We're currently down here. We're currently trading right here in June, and so we're in this middle area here. I'm looking for this to actually break higher and test the next area, and then the next area, and then the next area. I still think new highs are on the horizon. Nothing's really changed for the long-term trend. Okay, that's the monthly. That's the monthly, and then we want to look at the notes real quick. The 10-year note took a nosedive today, pushing yields higher. The 10-year note has did gap up on Sunday night and has retraced and has been sitting sideways until this morning. What's happening in the 10-year is it's resuming its prior auction and coming back into this balance that's here. So the 10-year is moving back to where it was before this whole default thing started this weekend. And that's the path that we're headed. If we look at the Bund, we see the same kind of thing where, where's the Bund? Right here. The Bund is basically sitting sideways, and this is the Sunday gap, and it's been sitting sideways on a downward skew since, and it's moving back into its prior balance to resume the auction. That's what we're looking for the market to return to the scene of the crime and for the auction to take back over rather than news driving what's happening. News drives market conditions on a temporary basis generally. Finally, as I promised, every Wednesday we're going to go through a trade wisdom segment to help folks who are learning or doing their best to make the turn. I don't like using the term trying. So the segment is champion on sim but trading live on Whim. Whim defined here, a sudden desire or change of mind, especially one that is unusual or unexplained. Does that ring a bell with live trades? You set out your plan. You go to trade it, and all of a sudden, Whim takes over. Generally, in my experience as a prop owner, trader, and so on, the major culprit is an emotional issue. There's constantly an outward focus on information and technique, and instead of looking, there's a certain point where technical information is not going to help you any further because you're not executing on it. So you can keep jumping from one indicator to the next or one course to the next, but the problem is mastering one and becoming confident in the way it responds or the market responds to it, whatever your approach is. So there's this constant with people that I've seen who are having this issue. There's a constant focus on going outwards and looking for the next thing to cover, to mask, or to work on the issue of them not being able to execute. So you can have the best trading system in the world, but if you don't execute it on a consistent basis or don't understand it and understand what the risks are associated with it, it's really a moot point. The problem lies in the emotional composition of the trader. The trader allows themselves to respond to a hardwired emotional response. We all have this in us. It's called the chimp mind. There's a great book on this called The Chimp Paradox. You can get a link for it on my website. But your emotional response is to a market that at the beginning, when you first started trading, you might have not been aware of the risks. We call that stage one of competence. And so you went out there fearless until one day you watched your entire account melt down, or you watched yourself melt down, and then now the market becomes this dangerous, hurtful and threatening entity. And as such, your response becomes an emotional one, and so you're not able to continue to follow your plan once you go live. None of that exists on Sim, so you're just an amazing trader on Sim, just swinging 300 lots and making millions of dollars on Sim. None of that exists in real life because emotions come into play. The market does not trade so much different on Sim as it does live, except that the fills are not realistic. So you can penalize your Sim results by a tick on your limit orders to make sure the market trades through, but the results are still unrealistic on Sim. So the only difference is in between your ears. So what you'll have to do, what's recommended, is set out what you'll do before the market opens. This is where the hypotheses that I talk about every morning come in. And so when you set out what you want to do, you're not listening, you're not being pulled like a ship without a rudder in different directions by different speakers. You have your plan, and your job is simply to monitor what is happening and how the market's responding to the levels or the areas that you expect it to trade. This is what I do every morning in these trader bites. Wait for the market to either confirm or deny your ideas. If your primary hypothesis is being denied, look to your second. If the second hypothesis seems to be working, the only step remaining is to find an area to trade against that would give you a good risk reward. And this takes time to do that on the fly, to do that on the hard right edge. But ultimately, the biggest problem I see with traders that I've backed and with traders at stage 5 who are learning to make the turn is this issue here. Knowing that every trade, as good as it looks or as bad as it looks, has a 50-50 outcome. Every single trade. You cannot get away from a 50-50 outcome regardless of the win rate of a system. I know that causes a lot of discussion and controversy, but this is the truth. You can only expect that you don't know where the winners or losers are going to come in an infinite data set, which was what the market is. So even if you have back tested your idea and it's 83% winning, you don't know the 17% of losers where they fall into the data set or in the population. So you have to understand that every trade has a 50-50 outcome. So interfering with a trade, and worse yet, not assessing the risk or not deciding on the risk of a trade is just a gamble. So the next thing we push is to enforce a mechanical trade management scheme, meaning if your platform can support it, put in your OCO orders or strategy orders and just keep your hands off the mouse as opposed to responding emotionally. The other thing I recommend traders to do is to look away from the dome and focus on the thing that caused you to take the trade, meaning your charts or whatever indication you use. Focus on that, because as it unfolds, you're not being trapped by the spoofing and the bids and offers that are coming across on your depth of market. Look at the chart and see how it unfolds, and constantly ask yourself, has anything changed? Has there been a change? Just because the position is going against you or the market's moving against you a few ticks in a position does not mean that your idea has been canceled. If the overall picture on the chart that generated the trade hasn't changed, then you should not be interfering with the trade. Micromanaging trades is just a very tough curse to get rid of, because it's a habit-forming thing, and it's pushed by emotions, and traders just aren't executing what their plan is. Write down what you did. I cannot overemphasize this. Write down what you planned. That's your before market. And write down what you did. If you write down what you did, you will not have confirmation bias. Your brain tends to forget those things you wish to forget, or that don't serve its immediate purpose. If you write these things down, and I suggest something like Evernote, a program like Evernote or OneNote to do this. This allows you to later read it and improve, which gives you your goals for next week, which I've talked about in the past. And then finally, trading is a continuous process. It has many setbacks, many leaps forward, it's just, you go through a lot as a trader, and it's not a linear process. We don't start and then we see our improvement do this. Trading is much more of a this sort of thing, and it gets wider and wider as you increase your size. You hope the lows are higher, but the highs should be a lot higher as well. And it's a performance sport, and you just need to stick with it for it to work out. Hopefully, good luck. I hope that helps you today. I'll catch you tomorrow.